Let's continue that conversation with Ed Yardeni today, president of Yardeni Research. And it's hard not to talk to Steve about that or read the Goldman note over the weekend and not think about your phrase, immaculate disinflation. Does this sound familiar to you?
It does indeed. Look, the CPI last week on Thursday, excluding shelter, just to continue this conversation, excluding shelter, it was up only at 2%. And if you take the core CPI, it was up 2.5%. So we're already on that basis awfully close to the Fed's target of 2%. And as Steve said, all we're really waiting for is for rent inflation to come down. Everybody knows that that's a bizarre lagging indicator of rents. Everybody knows that the Zillow index, the apartment list index, inflation rates have come down dramatically. So I think it's pretty much locked in. It's baked in the cake that we're going to see lower rent inflation, and that should offset some of the increases that we might get in oil prices. But I think overall, we're still looking at a disinflationary trend.
So when you think about, I mean, in Goldman's case, Q2, or certainly the markets somewhere around March, the notion of cuts, are you on board with that? And can it happen less from sort of emergency reaction and more to how real rates have become, at that point, maybe too restrictive?
Yeah, again, Steve mentioned the John Williams interview that occurred, I think it was actually August 2nd, and then it was picked up last week. But he said something extremely important. That is, he said that he focuses on real interest rates, not nominal interest rates. And what he thinks is that if inflation continues to moderate, that the Federal Reserve will have to lower interest rates. Otherwise, they're going to be increasingly restrictive. So I think they're already putting out there the idea that interest rates will be coming down next year if they continue to achieve their goal of moderating inflation. That's an extremely important message to get across to the bond market, because I think their number one risk now is that the disinversion that occurs in the yield curve occurs in an unusual fashion. Usually disinversion in the yield curve occurs as we get a recession, short-term rates come down, and bond yields come down. And that turns out to be a good, bullish, optimistic scenario for the market. This time around, the risk is that the bond yield just keeps going up. As you see, we're at 4.2%. And if it just keeps going up and up, that could create a whole new set of problems for the economy.
What are those problems, Ed, and how do you see an unwinding of the inversion of the yield curve? If we are able to essentially kind of skid by some sort of hard landing scenario.
Well, there's two disinversion scenarios, as I just suggested. One is where short-term rates come down and long-term rates come down, but short-term rates come down faster. The other disinversion scenario is not a happy one. It's a bearish, pessimistic one, where the bond yield keeps going up, moving up to where short-term rates are, and short-term rates are pretty close to 5%. And seeing the 10-year bond yield go from 4 to 5% would be pretty difficult for the banks. As it is, we already have a banking crisis. Moody's has downgraded the banks. It would mean more losses in their portfolios and perhaps shake up confidence in the banking system. So they don't want to go there. And then that would play, of course, on the commercial real estate market. Still higher mortgage lending rates in that market would be a disaster. It's already sort of a semi-disaster, would be a complete disaster. So I think John Williams is trying to kind of calm everybody down and talk down the bond yield from really spiking up here.